This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
This is your daily real estate syndication show. I'm your host, Sam Rust. Joining us today is Blake Selby. Blake is a 31-year-old direct private lender with $5 million in paid off real estate assets and $2 million liquid cash. I began as a real estate investor and transitioned into full-time direct private lending. We're going to dive into that. Blake is active in the real estate investing community out of the Iowa area and is always willing to share his knowledge and experience with others. Blake, thanks for hopping on the show today. Pleasure to have you.
Thanks so much for the opportunity. I really appreciate you having me on your show.
Yeah, for sure. Now, before we get into the nitty gritty of real estate, I was doing my homework and doing some research for this show. And am I speaking with a rap legend?
So I had a single with Twista that did get on the radio when I was younger. Twista's a fairly famous rapper out of Chicago, did some collaborations with Kanye West and some other things like that. So he's fairly well known. So he and I did some touring together. We sold out the Michigan Theater, and we did have some radio play. And then I had a few other singles that did pretty well, over 1 million streams on Spotify and some different things. They still have a channel for me. But that was in a past life. I still get royalty checks, which is very nice. But that was a past life for me, and it was something fun to do when I was 23. So.
Oh, that's fantastic. I'll admit, I did go onto Spotify. I found it. I listened to some of the music. That's fantastic. So what precipitated the switch from, you're out of college, you went to Michigan State,
right?
You're kind of doing this music thing for a little while.
Yeah.
What flipped in your mind to get you into real estate?
So the music thing for me was just a hobby. I mean, I actually went to Michigan State for a degree in exercise science, which is basically kinesiology. That's technically what my degree is, in a BS in kinesiology, Bachelor of Science. And I thought that I would be a gym owner, which I did right after college. But music was just something I did on the side. And I just happened to have these 2 songs that did really well. And I kind of thought maybe I'd go in that direction, but I was kind of noticing that the music industry was just a really tough grind. And I was just happy with what I did, and, made plenty of money doing that. And that was a nice little springboard, along with the gym that I had got running up in Bettendorf, Iowa, which is how I got here. And then basically did the gym for 3 years and then parlayed that into real estate. So that was once I made the switch into real estate, I stopped doing the music. I stopped doing the gym stuff. I just focused 100% on just that one thing. And that was a great move for me, because music becomes harder as you get older. It's, especially keeping up with the sound, it changes. I was relevant for my era, but I wouldn't be now. So
yeah, it is amazing how fast things change. Things don't change as quickly in real estate.
No.
There's a lot of time to find your lane, and then a lot of time to exploit those inherent advantages. So you were a gym owner. Did you own the real estate for your gym as well? Or was that just you own the franchise?
I didn't. I just had this gym. I was paying rent, huge rent. It was a massive gym, probably the size of a YMCA. I mean, we were paying, I think we had 15,000 square feet. It was massive.
Wow.
I mean, we had a separate CrossFit whole room that was just this massive CrossFit room. We had a separate UFC fighting room with, its own classes going on simultaneously, a separate personal training studio inside the gym, a separate cardio room, a separate gym room. So yeah, it was, and we had a full-on daycare, full-time daycare. We had a smoothie bar. We had, it was all of the things. So it was an interesting time. I made some money on it. Things were good. And then I actually sold the gym for about double what I was into it for. So that's what helped me out. But yeah, with music, it's a pyramid, right? So only the people at the top are making real money, or sustainable, where you could make a living. And it's very short-lived. With real estate, it's not so much like that. It seems like in real estate, most people who, if you're fairly conservative in what you're doing and you pick good assets, the average person can do moderately well in real estate if you do it for 10 years, right? So I don't know if you're going to get rich quick in real estate, especially being a landlord, but it's certainly a way to get things moving and grooving. And if you're an average person, I like to think I'm above average for what I've done in real estate. But even if you were doing it as a kind of a side thing, I think that you could do reasonably well if you gave it a decade.
Yeah. Well, I mean, just reading your bio, I mean, you've got a net worth that's approaching $10 million. That's in about 7 years of working in real estate, if I'm doing my math correctly.
You're doing it right.
That's better than moderate by almost anybody's standard. But listeners may have caught something that jumped out at me when I was first reading your bio, is that you've got 5 million in paid off assets.
Paid off. No loans, no debt, no partners, nothing.
Yeah. So could you explain kind of, that's not the typical entry in. Now you were maybe in a slightly different position because you sold your gym. You had maybe a bigger seed than a lot of other people do, but you know, there's so many different paths to make money in real estate. This is not a path that I've seen all that often. So walk us through how you figured out what your lane in real estate is, and then how you came to this strategy of paying it off as you go.
Yeah. So when I first sold the gym, one of my gym members was the vice president of a local bank that did portfolio loans. And what a portfolio loan is an in-house loan that doesn't have to get sold off to another bank. And so he knew what I was capable of, had been a member for 3 years, even though my financials were not up to snuff in terms of P&Ls and, tax returns. What I did have was a huge base of members. And in his mind, he had seen what we were doing, and he knew intimately was familiar with my situation. So he lent me $1 million through the portfolio loan. So not only did I have the money for my gym, but then I had $1 million loan on day one. So I'm not going to sit here and say that luck wasn't a huge part of it, because it was. That $1 million loan in the beginning was massive. I mean, obviously the sale of the gym was huge too. That was a large 6-figure amount. So I was cash heavy in some ways, cash heavy day one, where I had a lot of purchasing power. And so I went from 0 to 80 units in like just over a year. I mean, it was quick. And then ended up with 320 doors by 2019 with millions in debt. I took on tons of debt. And I just got to thinking, why am I suffering and struggling to, just to keep everything afloat, doing all of this extra work when I could just simply sell off maybe 200 of the units and then have the remaining 100 and something just paid off. And then I could essentially make the same amount of money doing, half the work. Well, turned out not only was able to sell those off at a huge profit, I was able to not only pay those remaining 100, and I think it's 106 off, but I was able to have 7 figures left over from that. And then also I retained most of the management on those contracts. So we've built that into like a 400 or 500 unit management arm of the business. And then we've done private lending. So it just kind of exploded from there. But that was the best decision I ever made. And we're in an up economy right now. But I was very fearful of, gosh, I've never made it through a downturn before. 2008 was before I did real estate. So I didn't know if I had massive debt. I didn't know how well I would necessarily weather a storm, especially with some of the legislation that's been going on with the pandemic and, eviction moratoriums and everything else going on. And in hindsight, it was the best move I could have made, but you never know. It's a big jump. So,
yeah. Oh, that's fantastic. So a little bit more detail on those units. Yeah. I've watched some content that you've put out on LinkedIn and other platforms. It looks like you've done a mix of small multifamily, maybe some mid-sized multifamily, and then some single-family residence. What's the perfect Blake Selby investment in real estate right now?
Yeah, right now, I mean, most of my portfolio is based around single family, but I do have multifamily. Of course, it's in there, and I started more with multifamily. I started with strip malls and multifamily. That was my first year of real estate. It was mostly multi. I don't dislike multifamily, but I do find that it's more competitive. So it's harder for me to get good deals on multifamily because there's less of it. And there's a lot of people investors that are seeking, bargain prices on it. With houses, I find that there's just so many friggin' houses. There's so many of them. I mean, it's you almost could never have enough competition for the bargain properties in the houses. But especially when you go 20 units and above in multifamily, I mean, it seems like everyone I talk to that asks me, "Hey, Blake, what do you got? What do you got? What do you got?" I just know a lot of landlords and stuff, and I have a bunch of off-market stuff that I know about. And they'll be like, "Man, what do you have over 20 units?" And I'm like, "I know about a lot of stuff over 20 units, but you're not going to like the price." So,
yeah, that has definitely been the case over the last couple of years. Now, one video that I saw you put out, you talked about the Uggs. Yes. I'm curious if you could share that. I think our audience would enjoy that. There's this idea that multifamily is the golden goose. There's no warts. It's perfect. There's a lot of gurus out there selling courses, and there's a lot of people, even myself included, that have done very, very well in multifamily. But I think that sometimes people get caught up in the euphoria, and there's a reality that you speak to quite eloquently. So I'll let you expound on the UGs.
I'll talk about the UGs. So multifamily, let me first say, on paper, multifamily slays the other asset classes on paper. So multifamily has amazing numbers, amazing cap rates. But the thing with having a bunch of people packed into a building like sardines is that you start to get these three things called the UGs, which is the first one's bugs. That's the hardest one. And that's bed bugs. And these are things that are more prevalent in like Class C and below type situations, which are really the only affordable things you could still buy in this market. But the bugs are going to be huge because bed bugs can cost, I probably spent at least $50,000 on bed bug remediation. And this is, again, nowadays, I don't own as many units. I do more private lending, but when I did own a ton of units, and bed bugs were extremely expensive. Sometimes you have to heat the whole building up and do a heat treat. And you can't just treat one unit. And then which tenant do you blame? Are they ever going to fess up to, oh yeah, I was the one that brought the bed bugs? No. So the landlord gets stuck, and sometimes you can actually have negative cap rates on buildings simply for that, which is crazy. So your good tenants will quickly move out if there's any kind of a bug issue. If you don't address it right away and spend all the money, your good tenants will move out rapidly. The bed bugs will spread. Obviously, I mean, roaches are much easier to deal with. You've got, all kinds of other fleas and other issues. So that's the bugs part of the UGs. Okay. Then you've got drugs. So if you have a meth den occurring in one of your apartments, guess what happens to all your good tenants when there's all these, randoms in the hallway at 3 a.m. and their kids are trying to, whatever, the kids are on their way to go out to get to the bus. And there's a bunch of, meth hooligans standing in the hallway. Like, you're not going to want to live there for your kids' safety, right? So the good tenants will move out to the drug problems. And then, of course, you have cops beating the doors down, knocking down doors to get to people. And guess who pays for that? The landlord. Good luck collecting on the tenant, especially in a Class C neighborhood. The other thing with the drugs is that when you have that many people coming in your common areas, funny things start to happen. Your camera cords start getting cut. Your coin washer machines grow legs, and they actually exit the building on their own, which I've had happen. Somebody literally came into my building and stole my coin washer and dryer out of the building.
Wow.
And cut the camera cords. I was like, wow, that's amazing. And then your trash, your dumpsters outside, when people are rapidly moving in and out of these units, and these meth people will let anybody stay with them. Your dumpsters are full of mattresses and all kinds of paraphernalia that's just strewn out outside. And then I guess the last group of the UGs is going to be the thugs. And so when you get infighting, which of course comes with the drugs, when you get infighting in your building and tenants are fighting each other and you're trying to solve, domestic disputes, you're trying to just tell the tenants, hey, you just call the cops because I can't do anything as a landlord. What am I going to do? Show up with a baseball bat? Solve this? Like, come on.
I'm going to join the fray.
No. So inevitably happens is that the good tenants will just simply move out if you don't provide them an immediate solution to that. And sometimes, it gets so bad that you've got incidents where there's holes in the drywall in the common areas where people have been fighting, the doors get, smashed and kicked in, and if they lose the key to their door, they're just going to break into their own door and then say, hey, my unit got broken into. How are you going to prove that it didn't? Good luck using those cut camera cords. So the bugs, thugs, and drugs, I mean, those are the main UGs that occur in not just multifamily, but especially in C class and below, kind of dense, packed multifamily in kind of lower end areas. That's what I found. Yeah. So I had some of that. So
well, I appreciate you sharing. That's something I can totally relate to on every single one of those. There's a battle that occurs. Now, I think the key, and you alluded to it there at the end, Blake, but the key is to identify what area you're moving into.
Right.
And I've seen people do pretty well on like C minus D plus assets, but your OpEx is going to be quite a bit higher than if you just took that a mile away into a slightly better part of town. You have to understand what kind of neighborhood are we going into? Can we attract the renters that will pay the higher rents that we're putting on our pro forma? Again, multifamily on paper, it's awesome. So one of the main reasons we're in it is because the business plan works.
Right.
But you really have to be aware of some of those issues, especially around location, because I feel like buying in the right location solves for the Uggs in many ways. I mean, bed bugs will go anywhere,
Right.
but you don't care as much if you're in a higher end part of town.
Today, our guest is George Roberts. George is a principal at Horizon Multifamily, which is focused on value-add opportunities in Central Florida. He's a founder of Walnut Grove Homes, an upscale residential construction company based in Troy, Michigan, which reached seven-figure status in 2021. He hosts The Foundry, where leaders are forged daily, a podcast devoted to entrepreneurs focused on syndication as well as both active and passive multifamily real estate investment. Today George talks about, obviously why real estate and just what's contributed most to his success. But it's interesting background he has as a bioscientist, and then moved into computer science and then construction. But he loved business, and so that's led him down some different paths, which is very interesting. And it just an interesting background. Often people say about my path, it just makes no sense, really. It doesn't seem to anyway. But he has a similar background. It's like, what? How did that lead to this? Where you're at now. But man, he is successful now, and just talking about their team and how they're doing deals, in Florida, and he's in Michigan, but he is after it in a big way, and shares some just great details with you, the listener, and myself, of how he has done it and what he's up to right now. George, welcome to the show. I know you have an interesting background, but I think the listeners would benefit a lot by hearing about some of the things you did in real estate before getting into syndication. And I want to hear, let's jump into, why syndication, why you would move that direction. But fill us in a little bit on some of your expertise before syndicating.
Sure. So back many years ago, over a decade, I was a bioscientist, very busy. It was the depths of the Great Recession, so I became an accidental landlord. It was a great experience, but I didn't really run it as a business. I was way too busy elsewhere, moved into computer science, had a little bit more time to focus on some other things, and that's when I moved into construction. It was after my father died, and he had always wanted to build on his property, but the Great Recession had just essentially wiped out that dream. And so then after he was gone, my sister and I decided that we would live that dream. And it showed me a completely new perspective on life, the entrepreneurial perspective. And I realized that I just loved business, but I wasn't needed to be there at the company every day. My brother-in-law got his construction license, and so he was running that company along with my sister. And so I decided, well, hey, I know real estate, but I want to get back into it the right way this time. Don't want to be a single family landlord. I'm going to put in the time to learn multifamily, and I'm going to become an apartment investor. So I guess that sort of dovetails with then why syndication. Well, hey, if joint ventures and being an apartment owner is good, well then being able to leverage resources and bring other people along for the ride, that's great. And so I really found that syndication model very appealing. And I was very excited then to take things to the next level.
You said a bioscientist?
Bioscientist, yeah. So I was in three fields. I was in microbiology, physiology, and genomics. So I was quite busy for a little while.
Yeah. So bioscientist, computer science, construction. I mean, it seems, some people hear my path to syndication there, and sarcastically they'll say, oh, that makes so much sense, because it just doesn't. But yours sounds somewhat similar in that regard. But moving into construction, even from computer science, bioscientist, but then on into real estate. I mean, people probably thought you were crazy, did they not?
Well, I've gone through some changes, but again, I think it's really the same route that most people describe. You realize you're selling your time for money.
That's right.
And especially when you're working in a laboratory, it's like 16 hours a day sometimes. It couldn't be any more on that end of the spectrum. And then going to computer science, I realized I'd have a little freedom at the end of the day. And that was all, part of being a family man and wanting to contribute in that respect. And so then when I discovered entrepreneurship and just to see, what a lever that is in terms of being able to be productive and being able to produce wealth, not just to be able to accomplish things. It's just a completely different perspective. So yeah, I think I turned that lever all the way to the opposite end.
No, that is awesome. And yeah, time for money. I mean, I was just reading another book. I mean, I've read so many books that talk about that, and we're all, as entrepreneurs, striving to get that time back, right? But you said you loved business, and real estate was obviously just a great means of bringing all these other people, or syndication specifically, these other people with you, in building wealth in real estate. Give us a little bit of that path, though, from going from construction up to syndication, and just how you had the confidence to get into the first syndication.
Yeah, great. So, going by stages, right? Everybody says start big. Everybody who's successful says start big. Now, I'm going to say something that other people may not tell you. There's something called survivorship bias. You don't meet the people in syndication who failed, right? You meet the ones who were successful. So everybody says start big. So I did follow that advice, and I think it is good advice. Started out looking for 100 units or more, and that would be great. Hey, if we had found that, and if we had found the right right sponsor to allow us to come on as co-sponsors and take those deals down, that would have been fine. So I would say, hey, go out and look for those big deals. But what actually came along was a 14 unit in Orlando. And this was a really sweet deal. It was found by my friend, Mark Prokop. He did a lot of the acquisitions work. He has some roots down there. And so he found that deal. It was kind of on the edge, an area that's a little rough, and there's an area that's really nice, and you have this transitional area. And so, at the outset, it was kind of hard to figure out whether that was the right thing to do, but we saw things transitioning after we laid eyes on it and could see that was definitely the right thing to do. So we started sort of small. So I had a joint venture of 3 going into that deal. And, let me tell you what a difference it makes, that first deal. You know this, but I don't know if all of your listeners know this. That first deal, no matter how big it is, 5 units or more puts you in that commercial multifamily space. And, obviously we're taken completely differently by the brokers after that. It was no longer a fight to see, hey, are they going to take us seriously? Now they're even taking us very seriously. If you look out to Tampa, which is not everybody, if you're not in Central Florida, you may not know just what a competitive market that is. You got your money going hard on day one, and I'm thinking, what is this, Texas? And so, it really gave us a lot of credibility. So from that, then it was a lot easier then to branch out. And so then more recently, one of our other partners at Horizon Multifamily, Tom Kirkpatrick, found us another great deal. This one is close to his neck of the woods in Jefferson City. And so we're looking forward to closing on that, hopefully maybe around the time this one actually comes out. So, again, you got to take action. I would say, try to start big. And if you find that big deal, go bring on a sponsor. And if you don't, whatever you do, if the numbers work, take it. And that small step is a bigger step than you realize.
I think the last thing you just said is so crucial. Like that you think it's a small step, but it's bigger than you realize. No doubt, closing the first deal just changes so many things about not only your relationships with brokers, but just your confidence level as well. Wouldn't you say, George?
Absolutely. It's a total game changer. And even after running that, hey, so we don't have other outside investors in the deal, right? We don't have that complicating factor. Maybe that's a good thing, right? Because it allowed us just to focus on this, to make whatever mistakes we had to make, and to step up. And again, I got to say, go look for the big deal, but whatever you get, take it when the numbers make sense. And that'll be a much bigger route to that bigger deal.
Could you speak to your partners a little bit to closing, let's say, the 14 unit or the next deal? But I know you all were JVing. Can you just speak to maybe briefly how you found them, but then how you knew those were good partnerships, and are you all syndicating together as well?
Yeah, so it's actually a rather big group. So we got five. It started out as a sort of a mastermind and sort of morphed into an actual company. So we got our construction leader, Mark Prokop. So he's also great with acquisitions. He's been in construction for almost 40 years, and he's also been a realtor. So he totally understands the business from one end to the other. And then I think he wanted me to focus on the partnerships and how we work together and how we know that this is good. Yeah. And so his brother, Paul, or Pav, as we call him, he's been a hard money lender in many deals going back well over a decade. Total experience, the sort of thing that we need to build the team. Again, I mentioned Tom Kirkpatrick, so he is in East Tennessee, and that's just wonderful to have our eyes on different markets. So we got Mark, who's now the boots on the ground in Orlando. We've got East Tennessee, just wonderful. People moving to Tennessee like crazy. Totally jumped to the top of the heap this year in terms of people moving in. And then we have one other partner, Steve Tappy. He's in Denver, Colorado, and he manages over $30 million of commercial real estate. So we have just an extraordinary breadth of experience. I guess I would say now, how do we know it's a good partnership? Well, first of all, obviously the quality of the relationships, that's something people often look over. But my favorite quote in business is J.P. Morgan, who said that a man whom he didn't trust couldn't get $1 from him based on all the bonds in Christendom. And so that interpersonal is very important. But more importantly, you have to complement each other. And you'll see we all come from different backgrounds. So a couple of us in construction, we've been in hard money lending and single family and fix and flips, and also commercial real estate. So all over the map.
I think it's worthy to highlight as well that you all met in a mastermind. Like, you were putting yourself out there. You joined a group of guys or gals that were out there doing stuff, and then you started those relationships. At least getting yourself out there to educate yourself, but also finding these other guys that were very experienced and created a partnership. But you had to start somewhere, right? And it sounds like did it start in that mastermind?
Yeah, so it did. So three of them then four of them actually had met. I want to say it was Michael Blanc's in Dallas. So they all went down there. Four of them met, and then I met the Prokop brothers at our local meetup, which then become our meetup. We now run that meetup, and it's really kind of exciting to see things come full circle. So that was my first multifamily meetup I'd gone to. Met my future partners after some time, and now we're using that to build our business in Southeast Michigan.
Yeah, no, that's great. And I just want, like, listeners that, if they're not putting themselves out there, if they're not going out and meeting people, if they're not getting becoming a part of some kind of mastermind or something, it's like, how do you expect to be known that, hey, there's other people that are looking for skills that maybe you have, and finding other people that you could potentially have partnerships with, just like George did. Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.